2024 is in the books and we are entering 2025 after 2 amazing years in the stock market. In this video, we're not going to summarize the week. We're going to summarize the whole year. We're going to summarize 2024 findings, things that we should look toward 2025, things that we should avoid, and get a better understanding of what really happened. So hello everyone and welcome back to the channel. If you're new, my name is Micha, and on this channel we talk about stocks, we talk about investments, and of course nothing is financial advice. It's only for educational purposes only. You're more than welcome to subscribe to the channel. We have 55.1k subscribers. You are more than welcome to subscribe as well. Okay, here we go. Let's start summarizing the year. And of course, we will start with the number 57. 57 times of new all-time highs, which means there were 56 times that the S&P made an all-time high. And you probably thought to yourself, should I buy now? It's an all-time high. I'll wait for a correction. Then another, and another, and another. 57 times of all-time highs. By the way, it's not the highest that we've encountered in the past. In 1964, we had 65 all-time highs. In 1995, we had 77. In 2017, we had 62. In 2021, we had 70. So maybe 2025 will have more. Who knows? Let's look at the major averages, and they had a phenomenal year. Look at the NASDAQ up 25.6% for the year. S&P 500, the major average, 500 of the biggest companies in the world, 24.8. Then the Dow Jones, almost 15%. But only the Russell was a laggard for the year, 11.38%. Which, by the way, in a regular year, if you had 11.3% performance gain on your portfolio, that is more than the average of the S&P 500 over a track record of 20 years. But in this year, where the S&P did 11% seems like something that you should be ashamed of. Let's look at the major indices as well. And when we look at them, you can see communications up almost 35%, financials up 30%, consumer discretionary up 26%, and utilities up 23%. On the flip side, you see materials, healthcare, and real estate up around 5% and less for the year. This was the year of the crypto. Bitcoin up 114.8% for the year. Ethereum up 42% for the year. During this year, we got 2 launches of major groups of ETFs, exchange-traded funds, where we got one for Bitcoin, actually 9 different ETFs, and several for Ethereum as well. This, of course, created a correction, but then a run-up. When you double your money investing in Bitcoin for the year, you can't really complain. Look at the commodities, natural gas with a 56% year. Gold, silver up 21 to 27%, and only crude oil didn't really do anything this year. Look at the Magnificent 7. This was another year for the Mag 7. Nvidia up for the year 171%. It's really, really crazy. Meta up 66%. Tesla up 62%, most of the gain coming after Trump election. Amazon up 44%, Google up 36%, and Apple up 30%. All of them beat the S&P 500, while Microsoft, the only big company that actually didn't outperform the major average, 12.9%. Is there trouble in Redmond? Who knows? And this is an interesting experiment I did from the first day of the second half of the year. Let me explain, because I'm not sure I explained it here on this channel. The first day of the second half of 2024, I decided to check which investment way or which investment vehicle is the right vehicle to use. I used 2 methods. One is a daily dollar cost average. Yes, I know usually dollar cost average is being done over every 14 days or every 30 days. It doesn't really matter. I tested a method where every day I bought with $5 a stock or a fraction of a stock from the S&P 500. And the comparison was the first day of the second half of 2024. I bought 141 days multiplied by 5. Okay. Lump sum versus dollar cost average. The biggest question that everyone thinks to themselves, should I buy my whole, let's say, IRA for 2025 on the first day of the year, or should I dollar cost average into it? Of course, if you have the option to do that. And these are the results. 6 months later, the dollar cost average on the S&P 500 was done through the SPY, the ETF tracking the S&P 500. I gained 3.3% for the year. Every day I bought $5. By the way, dividend were using the DRIP method. DRIP method is dividend reinvestment. So automatically, when I got a dividend, it bought more S&P. Versus when I bought it lump sum the first day of the second half of 2024, where I gained 9%. So at least for this experiment during 2024, buying once for the whole 6 months was better, a lot better, than buying on dollar cost average. I am going to continue this experiment during 2025. I'm going to check if I buy every day for $5 a day, would it be better from a performance perspective than buying at the first day, which is going to be Thursday, January 2nd, the whole amount. And right now, the amount of trading days is not clear yet, whether it's 220 or 225. It doesn't really matter. I'm going to buy the bigger option, and we're going to try, or the lower. It doesn't really matter. I'm going to check the performance. Very, very interesting. Okay. After we understood that, let's dive into the year. This is how the year performed. The blue line is the S&P 500, and each dot here is a major event that happened. Why is this important before we go into the headlines of 2024? You know the chart that says all the reasons to sell? Well, we never have a chart that says all the reasons to buy. But when you think about it, if the market keeps going up, and I'm talking about annual basis of years, not a specific day or week, then every day basically is a day to buy, and we're not focusing on that, we're focusing on days to sell. So let's check it out. Fed hints for rate cuts, the market goes up. Negative rates and Japan with a Japan move, it goes down. Powell signals rate cuts to take longer, the market goes up. And we can keep on going. Biden drops out, endorses Harris, the market goes down. Trump convicted, actually market goes up. Trump wins, the market goes up. Fed starts cutting. So as you can see, a lot of events during the year, with even NVIDIA becoming the biggest company in the world, didn't help it. Apple foreshadowed that later on. As you can see, all these events could be events that you might say, you know what, these are reasons to sell. But guess what? When the market keeps going up, there aren't really ever reasons to sell, only reasons to buy. Doesn't mean that there won't be reasons to sell. All it says that you understood that already. But the interesting thing is look at the same thing, same events, but actually focused on the 10-year yield. And I want to show you a few things that might be counterintuitive to the way you probably might think of things. Fed cites inflation setback, holds rate firm, yields go down. Fed starts going big and cuts by 50 basis points. Actually, the yields go up. Why did that phenomena happen? And why did we end the year almost at all-time high for 10 years, almost for 2 years high on the 10-year? Well, because the market believes that with Trump new policies, inflation might be on the rise. And Fed not only will not cut, maybe even increase rates. And the bond market is currently fighting the Fed and showing the Fed that they are probably not playing in the right game. Very, 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 very interesting phenomena going into 2025. Growth versus value. Again, growth wins in 2024. As you can see, the blue line here on the Russell 1000 growth versus 1000 value. You can see again another year where growth wins. You can see that over time since 1995 all the way to 2024. Growth continues to win value. If you are at a younger age and you're thinking of value companies, you should be very careful because your friend, and this is not financial advice, just know the numbers and know the statistics. Your friend, which is investing in the value stocks, is making over time better gains than you, not because they're taking a bigger risk, but because these are the numbers. Let's continue with sector performance. which stocks, which companies were the biggest contributors to the uplift of the S&P 500. You can see NVIDIA contributed the most from a value perspective, from a market cap gain. Apple, then Amazon, Meta. Of course, the Magnificent Seven, every percentage that they grow because of their size is a lot bigger than 10% of a smaller company. And you can see all the big companies here from the Magnificent Seven, adding Broadcom and Walmart and Berkshire and Netflix and JP Morgan, Oracle, Eli Lilly, Costco, Visa, MasterCard, GE, Bank of America, American Express, ServiceNow, Salesforce, Wells Fargo, T-Mobile, and Intuitive Surgical. Those were the biggest performance. And as you can see here, technology was the biggest contributor from percentage gain to the S&P 500. When we look at the mega caps, this is one of the things that the market will need to challenge, will have to challenge or actually debate itself during 2025. 2024 ended with the mega caps. You know them as Magnificent Seven, and if you add Broadcom inside, some people are calling them Batman or whatever the terminology would be. We are at the point where 8 companies contribute 35, or actually account for 35.7% of the market cap for the S&P 500. This is no doubt the most concentrated we have ever been. To someone that doesn't understand what it means that every dollar or every $100 that you pay for the S&P 500, 35.7% of it goes to only 8 companies. Now, so let's say it this way. It is skewed, but it's not that skewed, and I'll explain why. Of course, it's skewed. It's 35% for 8 companies out of 500. It's skewed. But the thing is, when you look at their net income, when you look at the contribution for profit to all the S&P, they're actually contributing around 22 to 25% of net income. So there is a skew between 25 to 35, but it's not that dramatic as people think. But yes, that's something that the market will need to digest. But we are not the market. We are retail investors. And as retail investors, you should look at this chart and explain to yourself, not to me, it's your money after all, why wouldn't you invest in them? Because 8 of the largest members averaged since 1994 almost a yearly gain every year except 4 years. Which means that when you ask yourself from a value perspective, from a security perspective, from whatever perspective you want, these 8 companies dominate the gains. And if you're okay with the volatility that they come with the fact that you might buy them high and not low, and all these questions, buying the biggest 8 companies did not underperform the market, meaning it outperformed the market. That's part of the problem, and that's why they grow, because everyone sees this chart and say, you know what, why am I even spending my time on, except S&P 500, buying individual stocks? I'll just buy the mega caps. And that's it. And you know what? From a mathematical perspective, they're not wrong. So that's something that the market will need to digest and see. No doubt it's going to be a topic of discussion with the market. And this is also very interesting. The triple plays for 2024. What is a triple play? A triple play is when a company during their earnings beat on revenue, beat on earnings, and raise their expectations. As you can see, the triple play stocks have outperformed the market in a dramatic way. Now, there's a caveat to that. I do not know if they outperformed the market before they triple played or after. So this chart does not account for the fact that they might have a run-up before their earnings and then maybe only correct some. But it says if you take these companies and you add them into a bucket, you basically outperform the market. Which again, if you're looking for ways to beat the S&P 500, sometimes you don't need to really confuse yourself too much. Just look at the triple plays, companies that have beat on earnings, revenue, and raise their expectation both on earnings and revenue, and you will outperform the market. And diversification, you probably heard that before. Well, international markets from 2014 till today have not outbeaten the S&P 500. As you can see here, the red line is S&P 500 or the US market versus all world. excluding US. Meaning, if you're looking for diversification, adding the rest of the world into your portfolio actually is, if you call diversification ruining your returns, then yes, diversify. But if you look for diversification for times that something else outperformed, well, international markets is not the way to do it. Going back, 57 times of all-time high. And this number, and what I'm going to say right now, is super, super important, at least from the numbers perspective. Again, it's not financial advice. It's something that we all need to recognize, because I had the same mistake when I was younger in the market. When I saw all-time highs, I said, no, wait, it's all-time high. I will wait for a correction. I'm not buying a breakout. I'm not buying an all-time high, which is a mistake. Why? Because the numbers prove that all-time high creates all-time high, creates all-time high, create all-time highs. Meaning when there is power, when there is energy generated from an all-time high, usually it creates another all-time high. Being afraid, and why am I mentioning that? Because if 2025, and we'll see it in a second, will start or a week or a month, doesn't matter when, we are going to see an all-time high, and you're going to say, oh, no, wait, all-time high, I'm not going to buy now. That mathematically, statistically, whatever you call it, would be a mistake. And by that, let's dive in directly to 2025. And this is why I've mentioned it. Everyone on Wall Street right now has a number that is higher than the current market. The current market entered at around 59.70, something like that. The lowest is UBS that says 5% to 6,400. The highest is Oppenheimer saying 7,100, which is 19%. You want to hear how right they are? Well, where do I have it? Here. Well, they're actually not that right. Over the last 24 years, forecasted price targets have actually missed the mark by 14% on average. In 2024, 100% of them missed the mark, which means that when you see these numbers, I can tell you that the likelihood of these numbers being met is very low. Why? Because when you have this kind of disparity between them, for sure some of them would be wrong and some of them would be right. Or maybe all of them would be wrong, just like 2024. In 2024, all of them underestimated the gains. Will they underestimate in 2025? Or actually, we will have a red year for 2025. No one knows, but this is something nice to look at. What is important as well, and that's something that you should consider, is corrections. Since 1950 to 2022, every year had 3% dips. 7 times a year. I would say it's almost twice a month, or once a month, actually. Okay? You should be ready every month to have a 3% dip. I'm talking S&P 500 right now. 3.4 times a year, meaning every quarter, there was a 5%. Again, every 3 months, you should expect a 5% correction. Every year, you should expect a 10% correction. Once a year, on average, 1.1%, meaning that some years there were 2 10% corrections. Every year and a half, you might get a 15% correction. Did we have a 15% correction in 2024? The answer is no, which means you should expect a 15% correction. Every 2.7 years or 3 years, you have a 20% correction, a bear market. Did we have it in 2024? No. Did we have it in 2023? Well, not exactly, because between 2022 and 2023, we did have it. By the way, we also had it in 2020, which means that actually, from a numbers perspective, maybe 2025, we won't get it, but we will get the 15%. I don't know, but that is something that you need to remember and get ready for. Why? Because it's math. It's not related to what you think about Apple or Nvidia or Microsoft. It's statistics. At the end of the day, the market corrects itself. It's a mechanism that is being done automatically. You don't know when, you don't know why, but you need to prepare for that. And the reason why you need to prepare, because if you know that during the year, at some time, let's assume it's going to happen, sometimes, you don't know when. Might be January, maybe February, maybe March, maybe April, maybe June, maybe July, maybe August, maybe September, maybe October, maybe November, maybe December. I'll have to finish all the months, otherwise it would be ridiculous. And you will get a 15% correction. You want to have the courage to put your money in because you know, and again, it's not financial advice, it's how the market works. You know that that would be a great buying opportunity. And why am I mentioning that? Because look how we ended in the fear and greed gauge 2024. We ended it fearful. S&P 500 did 25%, 57 all-time highs, and we are at fear. Usually when you look at fear, when you look at market momentum, when you look at stock price strength, when you look at breadth, when you're at extreme fear, these are buying opportunities. Now ask yourselves, did you buy yesterday? Or did you buy Tuesday? Or did you buy whenever this video is going to be posted? Did you buy? Probably the answer might be, no, I didn't. And that is exactly the issue. Because when market is very fearful, and currently it's just fear, it's not extreme fear, but when the market is fearful, that is exactly the time you want to buy. It's hard, it's difficult, but that is the time you want to buy. So that was volatility, those were them, and again, this is presenting that we didn't even have in 2024 more than 9% correction, which means that we might get that. And I'll end with a heat map of 2025, and the reason why I'm ending with that is not because I'm promoting or I'm getting money from someone investing in the S&P 500. But this map shows that if you tried to pick stocks without the right capabilities, you might have picked one of these amazing companies during 2024. You might have picked McDonald's, United Health, Johnson & Johnson, maybe Boeing, maybe AMD, maybe Intel, maybe Adobe, maybe UPS, maybe UNP, maybe CSX, and more and more. Why is that relevant? Maybe you're even wearing Lululemon shirts or pants, and maybe you've even went from Lululemon to Target, bought pharmacy at CVS. Why is that relevant? Because all the great logos that you see here, all the great companies that you see here, all of them underperformed the market. By the way, more of them actually underperformed the market. Look at all these. Look at all these. Look at all these. All of these amazing companies in the S&P 500 underperformed the market. And that is the reason why I'm putting this heat map. Because if you're trying to time the market, if you're trying to pick stocks and you don't have the right capabilities, you don't know how to analyze companies, you don't know how to analyze charts, you haven't practiced that, whatever, go with the index. Because the index did 25%, while these companies, all of these companies, were not even close. And these are great companies, all of them. Great management, great employees, all of them. But they underperformed the market. Look at Intel, down 60% for the year. And you might have thought, Intel, they should be the biggest producer. Taiwan, China, war. You heard a lot of horror stories. Well, 60% down when the market went up 25%. That would be the lesson for 2025. Will the S&P 500 keep performing the best, or we are going to see a red year? Currently, no one predicts it, but I've just explained that no prediction holds water when it comes to the stock market. Thank you very much for listening. I hope you enjoyed this annual summarize for 2024. I'm Micha Stocks. Keep following. Every week we're going to have a weekly summary. Maybe during the year I might upload more videos. We will see. Till next time. Bye-bye.